Welcome to the annual Private Equity and Venture Capital Compensation Report Summary. In our many years of publishing the annual report, both before and after the peak, we've seen significant changes in how private equity and venture capital compensation works. Both firms and individual investment professionals count on us to present a compensation benchmark that's reliable and affordable. We take this responsibility very seriously. Because of our dedication, the Private Equity Compensation Report has grown to become the most comprehensive benchmark for private equity and VC compensation practices in the entire industry. Annually, the team conducts a comprehensive survey to reveal insights into the changing landscape of private equity and VC comp. The data is collected in Q4 of each year to get the best picture of how the year will wrap up. All the data is collected directly from private equity and venture capital professionals. There's no estimates here. With more than 40 detailed charts and graphs, we've prepared this report to help you understand the industry pay benchmarks and changes in private equity and VC comp practices. The full report answers these questions and more. What are the compensation averages and ranges? What about the base pay and bonus payouts? Which titles earn the most and how do they earn that compensation? Who shares in carried interest and at what level? What forms of carry are people negotiating? And how does fund size affect pay? And how does fund performance affect bonus pay? And how are these professionals landing their jobs? What were they doing before this? And what's the work culture at the firms and how has that changed as well? Let's take a look at experience. Similar to our results of past years, most of our respondents are in the middle of their careers, with nearly 60% having between 6 and 15 years of work experience. The largest group of respondents have between 6 and 9 years of industry experience, but 10 to 15 years of broader work experience. The differential between work experience and industry experience can be largely explained by the fact that many professionals in the private equity and VC industries generally start out somewhere else and then move into the sector later in their careers, and they come from all walks of professional life. Year over year, we've been seeing a decrease in those working in venture capital-only enterprises. The strong demand for private equity funds, coupled with the economies of scale by running combined operations, are likely behind this trend. The total amount of deal flow in VC is also decreasing. It's down about 16% for the first 9 months of 2014 when compared to last year. The typical fund size, according to our respondents, has also increased year over year. This year, 20% of funds raised in the most recent round were in excess of $1 billion, where these large offerings comprised only 13% last year. Smaller funds did hold their ground, so much of the gains that we saw came from the very largest funds in the $100 million to $1 billion category. There is a trend towards smaller and more nimble teams, which positions a firm more strongly in reacting to these changing market conditions. In terms of the size of the firms beyond the immediate working group, we didn't see much change year over year for our respondents. There was a slight uptick in those working for firms in the 100+ employee range, offset by some declines in the 25 to 49 and 10 to 24 employee ranges. Overall, the data indicates a steady state in the average size of private equity and VC firms in the market. The overall level of confidence in pay increases for the private equity and VC professionals hasn't changed much from last year. We've seen a slight increase in the number of individuals expecting 0 to 15% increases, which was offset by a similar decline in those expecting to earn about the same as last year. This modest increase in optimism is offset by an increase of the number of respondents who actually expect to earn a little bit less than they did in the previous year. Reflecting a similar trend from last year, we found that bonuses comprise the largest proportion of comp for those professionals at the upper levels. Now, this is seemingly obvious, but we do see some movement in this each year. We did see the average base salary actually decline for the $500,000 to $1 million pay bracket from last year to this year. But increased bonuses, they pretty much filled that gap, resulting in little overall change. And of course, as we move down the spectrum of total comp, respondents indicated a trend towards an increased amount of their earnings coming from base compensation. So there's a bit more security at the lower levels. Respondents are quite a bit more optimistic this year on their fund performance as opposed to last year. We found that 22% of respondents expected returns of over 25% this year. So that's up from 19% the year prior. We also found gains in the up 10 to 24% as well as the 1 to 9% categories. And those were offset by declines in the number of respondents reporting even or negative performance. Again, private equity and VC firms have shown resilience in a market that's been up and down. We received some interesting responses this year with regard to bonus expectations by fund performance. While last year's survey we saw a clear correlation between bonus payout and fund performance, certainly not the case this year. Those with funds expected to lose 10% or more this year still expected to get bonuses of over $50,000 on average. While this may be due to personal objectives achieved, we do find this surprising given that we've seen an increased focus on transparency and investor returns, and those returns being factored into bonus arrangements. This is, however, a return to prior years where we didn't find a direct correlation to fund performance and bonus payouts. While respondents did indicate a narrowing of compensation for similar levels of professionals in different size firms, when it came to the funds that they were directly involved in, size did matter. Those working with funds in excess of $1 billion earned substantially higher bonuses this year than those working at the smaller to mid-sized funds. Mid-sized fund professionals earn the highest base salaries. However, those working in small-sized funds ended up with nearly the same total cash compensation, and they did that through achieving much higher bonuses. In general, carried interest allocations are typically around 20% of the fund's profit in both private equity and VC firms. Carried interest is then distributed to the firm's team members based on individual share of the fee, known as their personal carry. This year, we saw an increase in the size of the carried interest pool, with a 7% increase in the number of firms having a carry pool in excess of 20%. The two key factors in determining if a professional will participate in the carried interest plan, and if they do participate, how great a share they will receive, are years of experience and level within the firm. And this is something we see year in and year out. As expected, participation in the carried interest pool is mostly reserved for those at the highest level of the team. While last year we reported a decline in the number of associates being included in the carry pool, this year that group has made a slight comeback and is seeing increased participation. However, analysts have taken a considerable hit this year, with fewer than 5% participating compared to about 10% last year. At the upper levels of fund management, carry participation has been largely steady, with some modest declines in the number of managing directors and VPs participating in the carry pool. As expected, work experience is highly correlated with position in the firm, and accordingly is also related to carry percentage. We see two large jumps in participation this year, in the 6 to 9 year range, and then again in the 10 to 15 year range. After that amount of tenure, the carry pool participation becomes pretty stable. The Private Equity Comp Report has grown to become the most comprehensive benchmark for private equity and venture capital compensation in the entire industry. Unfortunately, we don't have time on this video to go through the entire private equity compensation report. As you can see, there's 46 detailed charts and graphs designed specifically to help you understand the industry pay benchmarks and guidelines in private equity and VC compensation practice. Whether you're an individual negotiating your compensation or you're a firm making sure that you've got the benchmarks you need to set your compensation guidelines, we hope you find the report helpful. If you're interested in learning more about private equity compensation practices, you can purchase and download the full report instantly at privateequitycompensation.com. Thank you and good luck with your efforts, whether you're negotiating your own comp package or setting benchmarks for your firm.